5 Biggest Investing Mistakes During Recessions. Expert advice. After a year of uncertainty, stock market volatility, and high inflation, a growing number of financial experts are warning about the potential for an approaching recession. JP Morgan's CEO Jamie Dimon suggests a recession to kick in within 9 months. And Goldman Sachs CEO David Solomon said that there is a good chance that the U.S. economy is heading for a recession. As we've seen in the past, recessions can have a major impact on investment portfolios. So, what are the biggest mistakes investors make during these periods of economic downturns? Mistake number 1 is not diversifying your portfolio. One of the most common mistakes investors make is failing to diversify their portfolios. When the stock market starts to head south, many investors think they need to sell all of their stocks and move into cash. The problem with selling all of your stocks and moving into cash is that you may miss out on the rebound. We saw this happen during the last recession in 2008. Those who sold everything and moved to cash missed out on the market rally that followed. To avoid this mistake, you need to have a diversified portfolio that includes stocks, bonds, and cash. This way, if the stock market does decline, you will have other investment vehicles to help offset the losses. Mistake number 2 is panic selling. Another common mistake investors make during recessions is panic selling. This happens when investors sell their investment positions out of fear that the market will continue to decline. The problem with panic selling is that it often leads to investors selling at the bottom of the market. If you try to time the stock market when it dips, you are likely to miss the rebound. Investors who try to time the stock market often find themselves buying high and selling low. The best way to weather a recession is to have a diversified portfolio that can weather the ups and downs. To avoid this mistake, you need to have an investment plan in place and stick to it. This way, you will know when to buy and sell investments, and you won't be swayed by emotions. The experts suggest defining your investment rules and sticking to them as a stock trader, no matter what the market conditions are. This will help you remain unaffected by your emotions and the conflicting views of other investors. Despite the ups and downs, the stock market has done well over time. So while money is an emotional thing, it pays to keep a level head and not let emotions dictate investment decisions. Mistake number 3 is not rebalancing your portfolio over time. Many investors also make the mistake of not rebalancing their portfolios. Over time, your investment mix will change as some investments increase in value and others decline. For example, let's say you have a portfolio that is evenly split between stocks and bonds. Due to market fluctuations and your own short-term goals, your portfolio may become unaligned with your long-term holding strategy. With your portfolio no more aligned with your goals, you may periodically need to rebalance it. Rebalancing involves selling some of your investment positions at appropriate times and using the proceeds to purchase other assets that you want to include in your portfolio. Generally, if a recession is approaching, you want to sell high-risk investment positions, such as stocks, and use the proceeds to purchase more conservative investments, such as bonds. This will help you protect your investment portfolio from losses during the recession. Mistake number 4 is not having an investment plan. Another mistake that investors make during recessions is not having an investment plan. Many investors fail to plan for their investment goals and instead focus on short-term gains. This often leads to investors making poor investment decisions that can jeopardize their investment portfolios. To avoid this mistake, you need to have a clear investment plan in place. This plan should include your investment goals, risk tolerance, and investment timeframe. With a clear investment plan, you will be less likely to make impulsive investment decisions that could jeopardize your investment portfolio. Mistake number 5 is investing based on emotions. For an investor, emotions are often the enemy. Many investors make investment decisions based on emotions, such as fear or greed. This often leads to investors making poor investment decisions that can have a negative impact on their investment portfolios. Recessions can be scary and uncertain times, and it can be tempting to make investment decisions based on emotions. However, this is often a recipe for disaster. With most investors making investment decisions based on emotions, it creates a self-fulfilling prophecy in the investment world and can further exacerbate economic downturns. To avoid this mistake, you need to be aware of your emotions and how they can impact your investment decisions. When you feel emotions such as fear or greed, take a step back and assess your investment situation. If you find that your emotions are impacting your investment decisions, it may be best to consult with a financial advisor to get an objective opinion. To summarize, the 5 biggest mistakes investors make during recessions are not diversifying their portfolios, panic selling, not rebalancing their portfolios, not having an investment plan, and investing based on emotions. By avoiding these mistakes, you will be in a better position to weather the economic downturn and come out ahead when the market recovers. With the world looking at a recession that seems to be just around the corner, it is more important than ever for investors to avoid costly mistakes. If you are unsure about your investment strategy during a recession, seek professional guidance from a financial advisor. Don't forget to subscribe to our channel, as we are always posting new videos on personal finance. Also, check out our website for more articles on this topic. Thanks for watching Think Tank Financial.